The plantation sector bonds have strongly benefited from the strong CPO rally in the past 2 years. This has led to healthy financials and low debt levels. Will this trend continue? And what are the attractive bonds in the plantation sector? Hello, welcome to another RHB Treasury podcast. I'm Chris Tan, Fixed Income Strategist at RHB Banking Group. So, the plantation sector has benefited from the strong CPO rally in the past 2 years, and this has led to bumper profits, which has resulted in healthy cash flows and low debt levels. The labor movement restriction during the pandemic has also limited plantax, which is plantation expenditures. This has helped companies to conserve capital. The string of events has lifted credit metrics of Malaysian and Indonesian plantation companies. Companies under this coverage, which is Bumitama, Sime Darby, Genting Plantation, Golden Agri, ILI Corporation, and FGB, has shown improving debt equity ratios during the past 4 years. The exceptions are KLK and Batu Kawan. In terms of EBITDA over debt service ratios, numbers also show improvement over the past 4 years. So, things are looking so good so far for plantation companies. Now, let's look at two important forward-looking catalysts that will anchor our stable outlook on the sector. Number one, established plantation players with healthy credit track record. The plantation bonds are issued by well-established large players which has long operating track record. In addition, as highlighted earlier, financial metrics has improved over the past few years, and we expect financial health to continue to be within the current range moving forward. Number two, CPO price supply-demand dynamics will keep CPO prices at current levels. In terms of supply, our base case expectations is for CPO supply to rebound strongly in 2023, and this is balanced out by a nominal growth in demand. According to our in-house forecast, CPO price will reach 3,900 ton for 2023 and 2024, and for 2025, we expect it to reach ringgit 3,800 per ton. An important discussion today is the CPO price is the formation of El Nino. This event will negatively impact fresh fruit bunches production and catalyze CPO prices higher. In our base case, we have imputed a mild El Nino into our forecast. As a mild El Nino, we have a small impact on fresh fruit bunch yields. However, a strong El Nino will strain fresh fruit bunch yields and likely lead to higher CPO prices, and our CPO assumptions will be revisited if such event materializes. Nevertheless, we expect the impact from El Nino on CPO supply to be seen in the second half of 2024. Now, other risks surrounding our plantation outlook are: number one, Russian-Ukraine conflict lifting commodity prices. Nevertheless, we have seen some such events in the past, but we think such scenarios is mitigated by the reduction on reliance on sea to transport commodities out of Ukraine, as land transport has replaced sea as a key transport. Number two, challenging environmental and labor rights in Europe. Although we think the demand growth from Asia could offset demand from the Western markets. Finally, we've moved on to our relative value section to see where the opportunities are in the plantation space. We think quality picks include Genting Plantation, KLK, Batu Kawan, and ILI Corporation. In terms of top value picks, we think Sime Darby, Golden Agri, and FGV offers slightly better yield to maturity returns. And Just to particularly mention, we like US dollar bonds of RLI Corporation, which is offering 6+% yield to maturity for a 7-year tenure. Thank you for tuning in and see you at the next podcast.